Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
Happy Monday, everyone, and welcome to Macro Mondays. I'm Andreas Steno, your regular host, and I'm all by myself this week as Mikkel's wife has given birth to his first daughter over the weekend. So congratulations to Mikkel, and we'll see you soon again in a few weeks' time. This week, we have plenty of stuff to cover because it's essentially one of those weeks where you've seen standard deviation moves across more or less all assets. But I'd like to start with a discussion on China, because essentially Chinese assets are through the roof after what happened in China last week. And the timing of that move in Chinese assets is interesting, given that we have a tsunami of liquidity upcoming in the fourth quarter, potentially both in China and in the US. So why this sudden tsunami of liquidity? What are the drivers and how do you position for it? It will be a major theme for today's show. And obviously, we have one of those major weeks in US key figures as well to look into. Nonfarm payrolls, ISM services, and all of those major key figure reports. So it's an action-packed program, and I'll allow myself to dig into it all by myself this week with Mikkel out of the office. And since Mikkel is out, this is an old meme of mine. At least have it saved on my phone, and I think it's hilarious because it's so telling for the difference between Europeans and Americans when it comes to out-of-office messages. So this example shown here is an out-of-office written by a European. I'm away camping for the summer. Please email me back in September. While the US Dito is, I've left the office for 2 hours to undergo kidney surgery, but you can reach me anytime on my cell phone. I think it's very telling, but I think it's also very fair that Mikkel is off today, given the great news he received over the weekend.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Enough about that, because China is through the roof. And when you look at the chart of the week here, Chinese fund flows have simply exploded ahead of this week. It is the golden week in China, meaning that the Chinese markets are essentially more or less closed for the week. But we obviously have trading ongoing in China and China proxies, for example, in Hong Kong. And the fund flows are through the roof. If you look at the volumes here on Monday, we're talking about a larger net volume in Hang Seng futures than the open interest. So the amount of futures in open interest have changed hands more than once during the day. If you look at the volumes, it's simply out of the ordinary. And I guess it's a result of that 5-6 standard deviation move we saw in China last week after the announcement of the stimulus package. So Is this a game changer for China? Do we have a much more benign setup for Chinese macro going into the fourth quarter? Let's have a look at the numbers because it's quite a substantial pamphlet of measures that they've presented in China. And they both have the central bank and obviously the Politburo involved in the planning of these measures. When you look at the pamphlet of measures announced last week, we're talking about rate cuts, we're talking about fiscal stimulus, we're talking about indirect stimulus to real estate markets, and we're talking about a rescue package for the equity market directly as well. So it is a wide range of measures. And starting with rate cuts, this chart shows the 7-day interest rate on the standing lending facility of the People's Bank of China. And they made a cut of 20 basis points to this facility late last week. Interestingly, that is the largest sequential move we've seen on that facility post the pandemic. They've basically moved in steps of 10 basis points up until last week. We're now talking 20 basis points. So again, I guess this is a signal that they actually mean business this time. They are accelerating the easing, both monetary and fiscally speaking. Rate cuts do not work wonders in an economy where the demand for credit is weak. So they're obviously trying to also underpin the sentiment around real estate markets and credit markets, which is much needed since the sentiment in China is absolutely on the floor when you ask households. But why this timing of stimulus? Why now? Well, as we've alluded to in this show over the course of August in particular, we've seen a clear shift downwards in the momentum for the export sector in China due to a hangover after a front loading of a lot of export activity ahead of the tariffs implementation over the summer. This is one of the variables that we use to nowcast the Chinese export momentum in real time, and it's a measure of the air pollution over industrial centers in China. And we've seen a landslide in that activity gauge basically since the beginning of August, due to export activity waning now that tariffs have been implemented both in the US and in the European Union. This is a major issue for China since this was the only part of the economy that was actually firing on all cylinders ahead of the summer vacation. And now that the export momentum is weak, they simply have to do something because otherwise all sectors in the economy are starting to suffer at the same time, which is obviously something that smells like a recession. And I've been saying it for a few months that without major stimulus, China would most likely enter a recession in the fourth quarter or maybe early next year. It's a bit more debatable after what they've done last week, but now that the export momentum is weak, they have to do something. They simply have to address the domestic weakness because they don't have this export sector to rely on compared to just a quarter ago. So what have they done? Well, first of all, when you look at how they're planning on underpinning financial assets, they have an equity rescue package in the works, and we have an alleged size of $113 billion. Is that a lot relative to the size of the Chinese market? Well, if you combine the market capitalization of the exchange in Hong Kong with the one in Shenzhen and the one in Shanghai, we're talking 11 trillion. And this is obviously before the major spike last week. And they announced a package of 113 billion. So we're talking less than a percentage point of the entire market cap. But I guess the signal value is much stronger than the nominal value of the package here. And most people I talk to and I discuss this topic with, they see this as the initial step in a series of a lot of steps going forward. So if this package is not enough to alter the picture, well, they'll just increase the nominal size of the package. And as long as we have that sentiment ongoing, it's very, very hard to lean against it, even if the numbers are minuscule relative to the market capitalization of stocks in China. Then we also got news on the so-called support program for unsold homes in China. most of you have heard about ghost cities and loads of unsold apartments and so on and so forth in China. It's a very true story. This is a measure in the chart of the amount of unsold homes in the largest 30 cities in China. And they now allow the regional governments to tap this special bond issuance with a 100% credit backing from the People's Bank of China to buy unsold homes in their regions. So assuming that they used the remaining outstanding of this special issuance, we're talking about $300 billion. So is that sizable relative to the amount of unsold homes out there? Well, we go from a $2 trillion issue to a little bit more than $1.5 trillion issue. So it's not like the issue is solved. It is structurally still very, very bad. But I guess the rate of change goes from being very, very bad to slightly more benign, which in turn is a change of the sort of probability of events going forward in Chinese real estate. So that's also why we've seen a positive response to this. But again, let me just emphasize that this is not sufficient to solve structural problems. But what it may solve is the short-term issues of a lot of hedge funds and hot money shorting Chinese assets right, left, and center. And the squeeze that we've seen in Chinese assets is likely a result of a few hedge funds blowing up. In these shorts in Chinese equities and real estate proxies, because it's been a very violent squeeze that we've seen in Chinese assets on the back of the announcement of these packages. But again, I'm tempted to say that they're bringing chopsticks to a gunfight here. If you look at the nominal size of these programs, we're still talking small numbers relative to the problem at hand. So I think for the momentum to continue to build in China, we simply need to see them announcing more and more and more and more measures over the coming weeks. And with this being a vacation week, this week, I don't think we should expect a lot of fireworks. But for now, obviously, a lot of people got caught short-sighted basically here by the developments. So commodities have also responded to this. You've seen a major spike Monday morning in iron ore, to some extent in copper, glass, for example. And I guess it's a result of the pessimism and the negativity around China sort of turning around here due to this announcement of stimulus measures. I'm still very skeptical that this is enough to dictate market trends, say 1-2 quarters ahead in copper, in iron ore, and so on and so forth. If you look at the amount of square meters newly built in China, we're still talking about 2008, 2009 levels, and it doesn't seem to me like the Chinese authorities are trying to sort of regain a lot of confidence in the real estate building activity. They obviously want to try and control the descent here, but they're not planning on building a lot of new stuff because that's essentially how they've conducted their fiscal policy for 10, 15 years. And they know that they're past the peak on that project, especially given the demographics in China. There are basically no reasons to build further apartments because they have no one to live in them, meaning that this is not the strategy that they will pursue. They will most likely try and get the domestic consumer to buy stuff via direct transfers, etc. And they have presented a lot of vouchers in big cities such as Shanghai over the past week as well. So we're also talking about stimulus directly aimed at bringing consumption up, rather than trying to make the construction activity rebound, because they know that it's not a feasible path for years ahead. So I'm skeptical, especially in relation to the response that we've seen in commodity markets, while equities could probably continue to soar in China on the back of this. So is this enough ultimately to turn the tide in China? I don't think so. But we'll see a lot of liquidity additions. We'll see a lot of stimulus, which is positive news globally speaking. But China, when you look at M1, so a relatively narrow measure of money, probably did too little too late here. to avoid a recession. So I'm of the view that we're talking about one of the biggest positioning squeezes in history, but it's not necessarily the start of a new fundamental positive story for China. This development. So interestingly, this setup in China arrives just before a liquidity addition in the U.S. market, and I think that's very relevant to discuss today as well, because today is obviously the final day of September. We know that we have a tight turn later today, given the tightness in dollar liquidity, but we also know that Q4 will be very benign. First and foremost, because we get a major liquidity addition from the U.S. Treasury over the coming 6 to 12 weeks, due to the U.S. Treasury emptying the Treasury General Account. What they communicated in the latest quarterly refunding announcement was that they planned on issuing roughly 550 billion worth of bonds, and that was under the assumption that the end of quarter cash balance for the fourth quarter would be 700 billion. They're not allowed to hold 700 billion worth of idle cash at the Fed if the debt ceiling suspension is not in place. We know the ultimate deadline is early January 2025. So up until they have a new debt ceiling suspension in place, the U.S. Treasury will simply have to limit issuance and use the idle cash instead, meaning that we'll have a very, very benign supply quarter coming up in U.S. Treasuries and liquidity additions incoming from the U.S. Treasury, as they will empty this cash balance instead of issuing new bonds. That's liquidity addition number one. Then through last week, we had Michael Barr of the Federal Open Market Committee out talking about the discount window. The discount window is a facility that is typically used under stressed circumstances, such as, for example, after the Silicon Valley Bank blew up, and such as around the pandemic and around the great financial crisis. As you can see on the chart here, we typically have spikes around such stressed scenarios in the discount window. And the discount window is a liquidity adding facility where you post collateral in return for liquidity. So what Michael Barr suggested was to alter sort of the rules or the playing field for the discount window to allow banks to use it on a running basis instead of using it only in stressed scenarios. So he basically wants banks to use the discount window in a more smooth way, where they don't feel like it's a panic signal to utilize the facility. And it seems like they're discussing within the Open Market Committee right now whether to allow banks to post the high-quality liquid assets that they hold idle for stressed scenarios in terms of liquidity, that they want banks to park those assets at the discount window, getting new liquidity in return. And that would basically underpin both the U.S. Treasury market, but also add liquidity at the same time. And why is that? Well, a high-quality liquid asset is typically either a dollar parked at the Federal Reserve or a U.S. Treasury, because the haircut on a U.S. Treasury in the high-quality liquid asset regulation is minimal. So a bank needs to hold a liquidity apparatus that can withstand a liquidity stress scenario. So either they hold them in dollar reserves or they hold them in treasuries plus other bonds, right? So if the discount window allows banks to sort of preemptively park those treasuries at the facility, and at the same time they'll get liquidity in return, that would both lead banks to hold more treasuries most likely, and it would lead banks to utilize the discount window on a running basis to a larger extent, adding liquidity as they park the collateral at the Fed and they get liquidity in return. if we take the European Central Bank as a case example of how much liquidity this could add if they decide to implement it, and given that Michael Barr has now talked about it openly, given that the Federal Reserve issued a frequently asked questions on the topic the 13th of August, we're probably talking about something that they plan on implementing very soon. When you look at the European case example, we have 3 trillion worth of excess liquidity, compared to a much lower minimum reserves requirement of reserves at the ECB. So the ratio between the two is roughly 5% minimum reserves versus the entire pool of reserves. I think a natural first step to expect is that the required reserves, or the minimum reserves, will be parked at the discount window in a case where Michael Barr and the Federal Reserve decides to alter the rules for the discount window and how it functions. So using the European case example here, we're talking about roughly 5% of the total liquidity pool being freed up as collateral is posted in return for liquidity additions. I think that's a feasible best guess, like say 6-7% of the entire liquidity pool will be freed up immediately with such a suggestion. So how much is that if we try to add it all up? Well, if we only look at the liquidity addition from the Treasury general account, so the Treasury adding liquidity due to no issuance of bonds in the fourth quarter ahead of the debt ceiling, we're talking about an increase of, say, roughly $500 billion for the fourth quarter. That's the blue dotted line in the chart I'm showing here. But if we add an alteration of the rules for the discount window on top of it, we're talking about another addition of, say, 5 to 7% of the liquidity pool, which is, again, upwards of, say, $300, $400, $500 billion. Depending on how quickly this is implemented, just during the fourth quarter. I don't have any strong clues on when they will implement this change, but given that they're now talking openly about it, I think it's something that you should monitor in the fourth quarter. So, in a best case, we're talking about a liquidity addition of $1 trillion just during the fourth quarter. This is where things get interesting. On top of that, here's a daily chart on the liquidity additions from the People's Bank of China. As you can see, we're starting to see a positive trajectory there as well. And with the cuts that they've made to the reserve requirements in China last week, we're talking about a renewed liquidity addition into the fourth quarter. Actually very similar to what the Federal Reserve is contemplating. So, ladies and gentlemen, the liquidity additions are here. And this is exactly the moment that we've been waiting for, as sort of a green light to lean more aggressively into risk assets, crypto, you name it. I think this is a very, very strong hint that the fourth quarter will be a solid return quarter, almost no matter what happens in the macro economy, because a wave of liquidity is arriving. So, in key figures and in macro, a few things worth watching this week. First of all, we've received the softest inflation report on record since 1999 from France last Friday. We received a similar very soft inflation report from Spain. This morning from Germany, we received some slightly hotter numbers, but the overall picture is that the inflation picture is benign in Europe. I think we'll get sort of a similar message when we see the numbers for September out of the US. And the only caveat to that right now is the strike that will likely commence around midnight in ports along the East Coast in the US. We've seen a clear front-loading of activity through the month of September on the West Coast. And I think this is related to the risk of the strike on the East Coast. As far as I'm concerned, the negotiations have kind of stalled, meaning that it is very likely that all ports along the East Coast will, or the employees will strike by midnight. This is interesting as it has led to a front-loading of activity already ahead of the strike deadline. that's something that will show up this week in ISM services and ISM manufacturing, in my opinion. I think we should expect them to rebound quite materially due to this front loading of shipping activity, for example, between LATAM and the US. Our model on the ISM service paints a picture of an increase of 2 to 2.5 index points just this month. Much better than feared by consensus. And we need to pair that with the unemployment report and the non-farm payrolls on Friday, obviously. I see a lot of the good forecasters, they've penciled in exactly 150K jobs on Friday. I think that's basically a result of recency bias because that's more or less what we've had the past couple of months, right? I think we'll see a slightly lower number than that. Given that we can see from withheld taxes adjusted for wage developments that the hiring is not really growing right now. And my best guess would be maybe around 100K jobs. But still, it will allow the Fed to cut more aggressively. We've seen how they've shifted their reaction function to be very aware of non-farm payrolls numbers. So maybe we get 50 basis points again in October, maybe also in December. I think that's likely still. And at the same time, we get a massive liquidity injection. So rate cuts, liquidity injections. I think we can look through a somewhat softer labor market in such a scenario. The labor market is backwards looking in many ways because you take decision based on past profits, not future profits when you're an employer. And that's why I'm not overly scared of a soft labor market report. I mean, yes, unemployment will tick up. Yes, hiring is low, but liquidity is arriving in size now. And that should more than alleviate my concerns and potentially your concerns out there in relation to risk assets. We got the consumer confidence numbers out last week from the US. And I think if you look at the details from that consumer confidence report, you basically have the best forward-looking model on earth to predict unemployment trends in the US. And we will get higher unemployment. This model suggests that we'll get to 5% before New Year's. I think, as far as I remember, the Fed penciled in 4.4% unemployment by New Year's at the last meeting. Again, this allows me to say that I think we'll get 50s instead of 25 basis point cuts because the Fed can use the labor market as an excuse. They'll add liquidity at the same time, rate cuts, liquidity, etc. I think it's time to turn upbeat on everything that is liquidity sensitive, rate cuts sensitives. So cheer up. That's basically the short and sweet message from this week's Macro Mondays. I hope you enjoyed listening to me, Andreas Steno, on a standalone basis. Hopefully we'll have Mikkel back in the studio with us next week. Until then, remember that everything in this show is based on our nowcasts and our assessments of liquidity, growth, and inflation trends. We aim at making tremendous returns on the back of this, but our trade ideas may be sometimes
maybe good, sometimes maybe shit.
Thank you to Gennaro Cattuso for always being readily available as a disclaimer in this show. My name is Andreas Steno. I'll see you again next week.
Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.